Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's winning trade. Hi everyone, my name's John Locke and I'd like to welcome you to The Winning Trade. But first, the required disclaimer. This presentation is given for educational purposes only. We're not broker-dealers or financial advisors, so we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial and make sure you are aware of all your risks prior to placing any trades. Also note that we are using hypothetical computer simulated trades and or results that are believed to be as accurately represented as possible, but keep in mind live trades can vary significantly from simulated trades for many different reasons. If this is your first experience with us, my name is John Locke. I'm a trading performance coach and success coach with Lock in Your Success LLC, and myself and my team help traders win in the market and in life as well. And I'm here today to guide you into the realm of high probability trading. Now in a moment, not yet, but in a moment, we're going to go over the winning trade. But before we do, let me quickly explain what we mean by an income or high probability trading strategy. An income strategy is where we put ourselves in the position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction, meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they might be otherwise. Now, when you find that you want more information as you're following along, simply contact us at lockinyoursuccess.com or ask a question in the comments on this video, and we can direct you to where you can find more information. Okay, let's move on. The winning trade that we're looking at today is called the V32. This is a shorter term broken wing butterfly style strategy that we trade on the Russell 2000 and that we regularly track in our options trading for income webinars. It's a fairly simple income strategy that's easy to manage and can be traded with as little as $3,500 per trade. The entry date varies depending on when the previous trade was exited, but for the purposes of demonstration, we're going to start the position about 30 days to expiration, or to be more precise, when the previous month expires, which in this case is going to be 29 days to expiration. It has an exit loss trigger of $250 per butterfly, which would be 7.1% of planned capital. As far as win rate, it wins historically over 80% of the time. The position has no profit target, but the average win when it wins historically runs about 5.5% of our planned capital per month. And we do have larger wins on occasion, with some wins being as high as 13%. Now, we are going to do an example size of a $35,000 trade. That's going to give us a loss limit of $2,500. And again, there is no profit target. Let's take a look at the position and see what it looks like. So this is our entry. Our June is going to be expiring today. We're 29 days to expiration, June 2019, and our July trade is 29 days to expiration, so it's June 20th, 2019. We're entering the July expiration options. We're going to sell our short strikes approximately 20 points behind the market. You can see the market's at 1563, so we're going 23 points in this case, and that's going to give us our 1540 short options. We're going to go down 60 points initially, 1, 2, 3, 4, 5, 6, and enter 10 long strikes. We're going to go up 40, 1, 2, 3, 4, and look at entering 10 long strikes at 1580. And from there, we're going to check our delta number. If we're not positive delta, then we're going to take 5 of these 1580s and roll them back to 1570. If we do that, this gives us positive 16 delta. That's what we're looking for. And from here, basically we're going to adjust up if the trade goes negative delta, and we're going to adjust down by rolling back. And the point at which we're going to adjust down is going to vary depending on where our upper long strikes or these strikes up here, depending on where these are. So if they're all at 1580, we're going to be rolling back when we hit 1540. As we roll these back, our rollback point actually goes higher. So for example, if all of these were at the 1570, our rollback point would be 1550. If all of these were at 1560, our rollback point would be at 1560. If all of these were at 1550, our rollback point would actually be up at 1570. So it's a variable rollback point depending on how short our upper wing is. If we start to come over capital or have capital problems, then we take this 1480 and we bring it up higher to 1490. So that's essentially the way that the trade works. And let's move forward. So our adjustment's only 4 days later. It's actually only 2 trading days. We put the position on and we immediately had a fairly hard down move, and we went right past our adjustment point, and the market's all the way down at 1530. You can see here we did take a bit of a loss because of the size of the move and the fact we were positive delta to start with, so we drew down a little bit, but no ways near our maximum loss of $2,500. This is going to require a rollback. So when we roll back, we essentially just go right back into the starting position again. So in this case here, I would remove these butterflies. I'd go about 20 points behind the market, which puts us at 1510. I'd sell 20 of my 1510s. I'd go down 60. And then I'd go up 40. Notice that I was negative delta. So I do 5 here and 5 here. And I would go into a position like that and be positive 21 delta. So that's the move we're going to make. Let me just clear this off and put the trade back on. You see we're rolled back to the 1510. We have 5 1540s, 5 1550s, and 10 1450s. We are down about $870, and we are positive 21 delta here. If we move forward 3 trading days, you can see we've gone negative delta, so we're minus 1.6 delta. So what we're going to do for an adjustment is we're going to roll back or move these 1550s down to 1540. That's going to bring us to positive 31 delta. If we take a look, we want to make sure our capital level's within reason, and our capital level's at about 31,000, so that's fine. And this is our new position. So let's just move forward here a couple of days. Here's Friday. We go over the weekend. There's Monday. When we come into Monday, the trading position has gone negative delta again. We're minus 21 delta. So we want to correct for that. And our adjustment is going to be to roll back some of these 1540s. When we do that, we get up near our $35,000 limit, and we do not want that. So what we're going to do to deal with that is going to bring these higher. That brings us down to 25,000 capital. It also brings us back negative delta again. So we're going to bring 10 of these down instead of 5. And this brings us to a positive 21 delta with a little over $30,000 in the position. So let's go ahead and make that move. I'm going to clear this out. And here is our new position. We're currently up $355. We go to Tuesday here. The market pulls back, but not an issue. By the way, our rollback point now is if the market hits 1530. And as of right now, we're still well above 1530, so we'll move forward. If we go to July 5th, you can see we're negative delta again. We're minus 3.25, so we will want to make an adjustment for that. And you see I just took 5 of these 1530s and brought them down to 1520. Our capital level here is still under 35,000, and we're now running positive 15 delta. Did get a, oh, by the way, too, our rollback points now at 1535, and we got a bit of a down move the following day, but no big deal here. Everything is looking fine. No adjustments here. We're up, let's see, 1245. Come into July 11th. We are now minus 4 delta. That calls for an up adjustment. When we do that, you notice we go over 35,000 in the capital. So we're going to roll these up. Brings us down under 30,000, and we're going to end up being positive 21 delta on the position. There's the move there. We're 8 days to expiration. 2 days to expiration. We are negative delta again, but here's the thing. This is our maximum adjustment on the trade. In other words, we're not allowed to adjust it any higher than this. So the trades at maximum delta were maximum adjustment were up 18.27, and everything looks fine. We're not going to do anything here. And we go to the 18th. Here is what we look like. We're up 18.27. We would close the trade here at about an $1,800 profit, and then we would go on and enter the following month, which in this case looks like this. This looks like the following month entry. And that was the V32 strategy, this episode's winning trade. If you like what you see, I encourage you to join us and discover how you too can follow along with this and other great strategies as they unfold during our weekly Options Trading for Income webinars. If you have any questions or comments or anything you'd like to see in the next winning trade, we'd love to hear from you. Simply comment on this video below so we can get those questions answered for you. And we would also encourage you to come on over to thewinningtrade.com, where you can find past episodes of The Winning Trade, as well as lots of other fantastic information on how to profit through income trading. Thank you, and we'll see you on the next Winning Trade.